And welcome back. So expanding on the lesson on money management, we're now going to walk you through some money management exercises to really reinforce these ideas. So here's our first exercise, number one. It's all about the 2% risk rule. So let's say that you've got a $50,000 trading account. You wish to buy AMP at $5.72 and you're expecting it to rally to $6.85, which is up near that peak. Your stop loss position is under the trough low at $5.49. You're thinking you'd like to buy 4,000 shares. Now the question becomes, can we afford to do that? So really, to understand this, we need to know what's 2% of our trading account. And if we purchased 4,000 shares, is it within that risk? Let's take a look. So the answer is yes. So if we consider the 2% rule, the risk is 4,000 by 23 cents trade risk gives you a total of $920 risk. Now that is less than 2% of the $50,000 trading account. So 2%, so $50,000 multiplied by 2% would give you $1,000 risk. However, even though we're within our 2% risk rule, have we considered the overall trade size? And what would this work out to be if A, you work out the amount of shares you've calculated from the 2% rule, or B, you just work on the 4,000 shares you had in mind to begin with? All right, so continuing along, looking at A, recalling that the position size is the risk divided by the stop distance, so our trade risk in dollars. So $1,000 is 2% of the $50,000 trading account. And we're going to divide that by the trade risk of 23 cents. And that gives you 4,348 shares and an outlay of $24,870. So that's what's going to cost you to buy these shares. So if you multiply the price you're buying the shares at, so $5.72, by the number of shares you want to buy, 4,348, we're outlaying $24,870. So that's nearly 50% of our $50,000 trading account. So we're suddenly outlaying a lot, way too much money here. So looking at B, at 4,000 shares, the position size would be 4,000 multiplied by the entry price of $5.72, an outlay of $22,880. Now this is still over 45% of our trading account. Therefore, if we want to be able to participate in more than 2 trades at a time, we would need to reduce the position size. So what do you think would be the best way to do that? All right, so option 1, simply chop the position size in half. So if you do this, your risk will become 1% rather than 2%. Sounds like a safe idea. But what if the reason your 2% calculation came out so top heavy was that your stop loss was too tight? So remember, your trade risk is the difference between your entry price and your initial stop. Have you placed the stop too close? Recall that there is an inverse relationship between the stop distance and the eventual trade size, i.e. the tighter your stop is, the smaller the trade risk becomes, the larger the position size. This being the case, by simply halving the position size and leaving the stop alone, you might have a smaller risk amount, but also potentially a far greater chance of getting stopped out of the trade that may have proven to be profitable if given enough breathing space to begin with. So in other words, is our stop too tight? Therefore, always reevaluate your stop loss position before reducing the trade size. Only reduce the trade size if you are 100% happy that your stop is not too tight. So for example, a series of 2% risks with a 70% chance of success is far better than a string of 1% risk with a 70% chance of failure. So option 2, revisit the stop loss and determine whether the lower support level might be safer, as well as reducing the trade size to a more comfortable amount. So for example, less than 25% of our capital base. So that's really what we're aiming for, is to get that outlay under 25% of our account. So let's take a look at the chart once again. So this was the current stop we're using in our current example. This is the revised safer stop option down here under this trough low, which is the long-term trend line test. So with the safer option, so that's under the trend line trough low, the stop goes under the medium-term trough at $4.98. Therefore, position size equals risk in dollars divided by the stop distance. So again, our trade risk. So $1,000, so that's 2% of your $50,000 trading account, divided by our new trade risk, which is 74 cents under the new trough low near the trend line. And that equals 1,351 shares. So if you're going to buy 1,351 shares at $5.72, multiplying the two together, your outlay is $7,728. And that's about 50% of your trading capital. So well under our 25% maximum outlay. So that's a lot better. And a safer stop. And that's what it went on to do. So have a look at the scenario here. If you'd gone with the tight stop and simply halved the amount, you would have been stopped out with a loss. By using the revised, more conservative, looser stop placement, we've survived a rangy patch, and the trade actually went on to become a winner. So question 2 is all about the 6% rule. So you start the month with a $100,000 trading account. You get stopped out of your first trade quickly, having assigned a risk of 2,000. So that's your maximum risk here. So that's your 2% risk of your $100,000 account. You then enter 2 more positions, each with 1,000 shares, with a stop loss at $1.90 and $1.70 below the entry prices. You then identify another great trading opportunity on a shares that just pulled back and bounced off strong support at $2. The question is, can we afford to take this trade? Let's take a look. So the answer is no. So again, remembering we need to think about the 6% rule. 6% of $100,000 account is $6,000. So this is our maximum risk for the month. Now we've already lost $2,000 and we have 2 open trades with another $3,600 at risk. Therefore, $5,600 is at risk or lost from the 6% monthly drawdown limit of $6,000. So there'd be no room for another trade. With only $400 to risk, the break-even point would be unrealistic due to the minimum brokerage requirements. The price would need to move to $2.35, which is about a 17.5% rise, just to break even on this trade. All right, so question 3, again relating to the 6% rule. So we start the month this time with a $90,000 account. You take 2 trades, A and B, risking $1,200 each. So that's 2% of our $90,000 account. You lose both from being sold at your initial stop losses, so stopped out on both of them. You then take trades C and D, and you're risking 1,500 on each. You get ahead on both and move your stops up to the break-even point. Trade E, you want to buy 1,000 shares with a stop loss at $1.80 below the entry price. The question is, can we afford to take this trade? We want to buy 1,000 shares with a stop loss at $1.80 below the entry price. The answer is yes. So 6% of $90,000 account is $5,400, the maximum risk for the month. We've already lost $2,400. But trades C and D are no longer at risk because the stops have been moved up to break even. The balance of risk available is $3,000. Trade E has $1,800 at risk. Therefore, less than 6% of the capital at risk. So you still have $1,200 left out of the $5,400 total risk for the month. So I hope those exercises have assisted you in understanding some of the key principles of money management.